Okay. So if I could ask people to take their seat. Yes, are we on? Yep. Good morning in Washington. Hello, everyone worldwide. Welcome back to the Peterson Institute for International Economics, where we're launching another edition of Macro Week. We had a brief start yesterday with the Saudi Minister of Finance, Mr. Al-Jaber, on in his role as minister, but also talking about issues for the IMFC. This morning, we are very privileged and pleased to be hosting Mario Centeno, forgive my pronunciation, governor of the Bank of Portugal, and of course, a member of the European Governing Council of the European Central Bank. Mario has been in that role since July of 2020, and he and the Bank of Portugal have already made a substantive mark. He has served previously as president of the Eurogroup and chair of the Board of Governors of the European Stability Mechanism, two absolutely critical roles in Europe, and which helps bring a not narrow monetary policy, a broader economic and finance ministry kind of view from him into the ECB and European discussions. He also served for 4 years as finance minister of Portugal. Earlier in his career, he is an experienced economist with a PhD in economics from Harvard, which I approve of as fellow alum, and served in several positions in the Banco de Portugal, as well as publishing academic research. The governor is speaking, of course, on the record, and we are fortunate to have him in particular, not just because of his own virtues and not just because of the importance of his and the Bank of Portugal's role in the European political economy, but because, as we're going to emphasize throughout this macro week, we see a world in which the actions of what we're calling third nations, meaning people who are not policymakers who are not China, not the US, and in particular, like-minded smaller economies have a role to play constructively in the world economy, whatever happens in the US election, whatever happens in China. And it's in that spirit that we're very proud to have Governor Centeno with us today. Thank you very much.
Well, thank you, Adam, for inviting me, for always being a source of inspiration. Whatever happens in your institution is important for the way we see the economy, our duties as policymakers, and that's very important. So it's a great honor to be this morning with you. I'll be telling you a few things on the European economy and seeing the European economy through the lenses of monetary policy. That's my duty right now in Europe, and I'd like to divert your attention to what is going on with the European economy, and that explains what happened so far during this inflationary process. So I'll have three main objectives today. First, telling you why I see inflation already converging to the 2% target. Hopefully we can get there and we can stay there because the risks exist that this may not happen. Then I will drive you through the experience of growth in Europe, making a few comparisons with the US. A special focus on the labor market is due with this respect, and also differences in terms of fiscal policies that also explain the part of what is going on into the sides of the ocean. And then I'll try to draw some policy implications. Well, there has been quite a debate on whether or not inflation converged to the 2% target already. And let me tell you a small anecdote that you all know probably, but that will introduce a new taxonomy for what is going on in Europe these days. And you can remember this joke on a tall mathematician and a short statistician, both shy, meeting in a pub. Having spotted an attractive person, say a target of 2%, they decide on a comfortable approaching rule. They will take steps, but each step would have to be half the size of the previous one. So today, the mathematician is still on his way to the target, but the statistician has converged, at least in probability. So my view is that inflation has converged on solid economic fundamentals, and I'll tell you why this is the case. So I'm going to invite you to walk the slopes of economics and explore how far we have come. And here comes the taxonomy. Instead of calling us doves and hawks, we change for a while, only for a while, and call us mathematicians and statisticians. And these will reflect the different views that we have in Europe on whether or not we converge. And the graph that I have in this slide is pretty clear. Inflation went up for a long period of time. It took us very long to get to the peak. This was because shocks came in succession, not all at the same time. And so they were feeding each other and helping in inflation spreading from energy and food and metals to other items of the HICP. And then, since October 2022, inflation started going down faster than it went up. And it took us to a very close position vis-à-vis the target, below 3% clearly, and the last print of inflation in Europe is 1.7, already below the target. We still expect inflation to go up, but probably we will not see inflation in the coming quarters in Europe clearly above 2%, and our forecast points to inflation actually being below 2% after half of 2025. So that's the statistical story of inflation in Europe, and it has come down. Actually, if you look at the history of inflation in the Eurozone, most of the time, inflation is in the range between 1.5 and 2.4. If we round this, it's 2. And this is a comfortable position for inflation in Europe. Reaching the target precisely at 2.0 is something of a statistical nature, and we should not be very worried about that. So why did inflation converge? I'm going to be brief, but I'll follow 4 points in this. First, markets worked efficiently in Europe, most notably the labor market. We have observed quite significant, I'm going to call it a market-based risk-sharing mechanism between employees and employers that helped inflation through the process of deflation, of reducing the figures for inflation in this period. First, we had a quite significant decrease in real wages, quite pronounced reduction in real wages while inflation was going up. And now we really need real wages to recover. And the way this is operating in Europe is that profit margins are accommodating, are absorbing somehow these supposedly pressure on wages. So the labor market seen from this side, and actually also the relationship within firms between employers and employees has worked quite positively. But the labor market goes beyond that, and we did not see in Europe, contrary to what happened in the US, a shift in the beverage curve. So no issues relating with labor market efficiency arise in Europe. And when we look through these numbers and look at the composition of both employment and unemployment, we see some merits to the European labor market. It is a much more mobile labor market than it used to be. Migration make up 60% of the significant increase in employment in Europe. We increased employment in Europe by 11 million jobs since the worst moment of the COVID crisis. 11 million jobs in 4 years. And 60% of those are occupied by people that are working in a country different from the one they were born. And when you look at churning and new hires in Europe, it went up compared with the pre-COVID crisis. So these numbers show a great deal of adjustment in employment, but also in unemployment. Europe was described very often as a sclerotic labor market in which the unemployment pool used to be a stagnant pool of workers. So we now have shorter durations of unemployment in Europe, and subsidized unemployment also went down. So we see more flexibility these days in the European labor market, and that was good. That helped a lot in terms of this reduction of inflation that we observed. We also had quite a bit of a success in monetary policy transmission terms. So it was quite effective and it was fast. Well, we had a huge shock, 450 basis points. It's the sharpest increase in interest rates in the shortest period of time that we have on record. But it had a quite significant impact in credit flows. They decline in nominal terms. So if you do this in real terms, it is even more impressive. And transmission occurred in Europe this time without fragmentation concerns. That's because we reinforced over the years the institutional landscape in Europe, not only the banking union, the resolution dimension of it, the creation of these backstops in terms of the European Stability Mechanism, but also the central bank, the ECB. We created in July 2022 another backstop, the Transmission Protection Instrument, which is an insurance mechanism. We did not have to use it. It's good because it exists, and it's, again, shielding Europe against these fragmentation concerns that actually did not surface this time. The third reason is because for the first time, fiscal and monetary policies were coordinated in Europe. We had a great deal of cooperation. I hesitate about calling it coordination because we really did not meet together. We were not taking decisions together, but they worked in the same direction. There's a very nice piece of paper by the IMF precisely showing the role of fiscal subsidies to energy in reducing the amplitude of the inflationary impact of these oil crisis in Europe, and that helped in terms of in terms of what central banks, the ECB, had to deliver in terms of its mission. The fiscal stimulus in the US, on the contrary, played quite a significant differently way. I mean, we have, if you sum the deficits in the last 9 years of the US and the euro area, you get into a difference of 31 percentage points in terms of GDP. That's a huge difference for the fiscal policy in both areas. And let me add another element that I attach quite a significant impact when you look at Europe, and you have to understand why this financial stability was what we take out of the European experience. And that's the issuance of common debt. We finance the response to the COVID crisis through a great amount of common debt. The European Commission was between 21 and 23 the largest AAA issuer of debt in Europe, and that again played a significant role in the market, calming down all these historical concerns around the euro that we observed in previous crises. Finally, the supply side pressures eased. Of course, this was a global event. Markets adjusted over time, and we do see now no pressures, inflationary pressures coming from the supply side, which was exactly the opposite at the beginning of all of this. So these are the 4 reasons why I see and I am convinced that the economy tells us that inflation converged in Europe. So what is going on now in the real side of the economy? And that's a problem. I'm going to be brief. We can then discuss this further. But the European economy is not investing, and so it is not growing. We are not growing, virtually zero growth, almost zero growth, since the second quarter of 2022. And investment has been almost flat. Actually, the latest numbers are quite negative quarter on quarter. This does not give good prospects for investment in Europe in the quarters to come. And at the end of 2025, investment will be at the 23 level in Europe. And that's not the ingredient we like to see for an economy that needs to grow and needs to recover. So what are the risks? The risks are, if I have to sum them up, I'll say that I see more risks in undershooting target inflation than the other way around. And most of the risks that we see, the downside risks that we see right now in our projections, they are endogenous. They are not external shocks to the economy. If you go through them, and we usually list them at the ECB, we see there stronger monetary policy transmission. So if the transmission plays out stronger, then we consider right now this will dampen demand further and will be a problem to economic recovery. And we see, both for consumers and investment, low confidence, high savings being kind of a break in short-term recovery. It is good to have high savings. It will tell something about the future, but in this stage of the recovery, it's not going to help. And there are early signs that the labor market resilience is weakening. We do have recent job starters falling by 10% vis-a-vis the second quarter of 2022, which was the moment in which we start hiking, and probably more importantly, job vacancies declining 21%. So these are numbers that already put some question marks in terms of what we can expect for Europe in the coming quarters, and being those endogenous signs and endogenous mechanisms from the economy, I think it's on policy. It's on our duty, so we have to take care of those. So what will be, and this is the last slide, the policy response? I think that we have to continue the European tradition on generating fiscal space and fiscal not being procyclical. It is a little bit of a difficult situation right now because we have a very, very strong labor market with highest level of employment ever and wages, but we don't have the economy working with us. So the response of fiscal policy is tricky, but under the treaties, it has to remain counter-cyclical in nature, and fiscal revenue in Europe is still very high, and this money should be used to create buffers. That's our position. It is true, again, that this difference between the US and Europe in terms of the fiscal generate differences in growth. We have to take them into account when analyzing growth in Europe, but still that's the way to go. Of course, we need to continue reinforcing the institutional landscape in Europe. We have a lot to do, we do know that. I'm not going to mention the Mario Draghi's report, but I could. It's a lot of things need to be done, and we need to continue that. Let me finalize with monetary policy. I see monetary policy as continuing this gradual but steady, predictable path towards more neutral levels for the interest rate. We were discussing this just a few minutes ago. Maybe 2% or slightly below 2% is this neutral territory for interest rates. That's where most estimates land right now. It's possible that as we approach this figure, we need to really evaluate while that's the case or not, but certainly at 3.25 as it is right now, the DFR is still way above the neutral level, so this process is to continue. And thank you for having me, and happy to discuss with you.
I jumped. Thank you very much, Governor Centeno. I want to, just before starting the discussion, say thank you for your forthright remarks on U.S. fiscal. I think you characterized it as laxity. The late Pete Peterson, co-founder of the Institute, and our current board chair, Michael Peterson, will welcome you back for having said that. But maybe that's a good place to start. How much do you think U.S. outperformance on growth versus Europe in recent years is due to fiscal expansion? And is there a discussion worth having in Europe, in the Euro area, about what in the U.S. we refer to as running the economy hot? As you know from Jackson Hole conferences and your BIS meetings with central bankers and on, there is a lot of positive feel in the U.S. for both the Fed and the federal government keeping the economy running at a high rate of employment. Do you think this is something dangerous? Do you think this is something Europe can learn from? Anyway, how do you see it?
Well, that's a very core question to all of us. And coming now from the monetary side of policy and being before in the the fiscal side, I have always mixed feelings about it. Believe me, but in positive terms, it's obvious that 30 percentage points of that, if they happen to be sustainable, was a great idea.
Yeah.
And I don't know what will be the multiplier, but in the literature you see for every 5 percentage points of debt, you have 0.6 in terms of growth. I don't know if this is the best benchmark, but it is certainly going in this direction, and it is playing a role. Okay. The fiscal conservatism of Europe is embedded in the treaties. We reached 2019 with an overall deficit of the Eurozone of 0.4%. Risk reduction was quite significant by then. And during this period, the growth differential with the US was not very large. It can be solely explained by this back of the envelope sort of elasticity calculation, because the difference in fiscal policies by then was already quite significant, amounting to 15 percentage points in 4 years. And if you multiply that by 0.6, you can easily explain the growth differential before COVID. But this growth differential widened very significantly after COVID. The European economy is not investing. We don't see signs of that changing in the near future, despite the big impulse of public investment via Next Generation EU funds. Because this amount of money that we devoted collectively in Europe to the COVID response through financing mechanisms at the European Commission level, they are helping the investment figures, but still the private side is not actually responding. So the difficult part of the answer is when it becomes normative and myself saying that, well, we need to see if this trade-off is well played or if you can be more expansive in fiscal or not. The way we do see this is that still right now, with the labor market that we have, the stimulus should come from other sources other than fiscal. That's why I think it is to the point, and it is important for monetary policy to continue this easing process to the limit of our capacities. We also then discuss growth in Europe, and we have to talk about structural reforms and structural issues. They all exist. I mean, the Draghi's report is a good document to go through to identify some of these bottlenecks. I am in agreement with most of what is in that report. We need to continue doing those, but we also need to look at Europe and see it. I sometimes call it the most stable contribution to the global economy that we have. We didn't have this fiscal response of the US, neither the treatment of the pandemics as in China, or what happened in the UK with Brexit and then the Liz Truss event. We played out quite conservatively, but also quite stable, and that's good for Europe. It takes time, probably, for all of this to pay off, and we need to continue in it.
Thank you. There's a lot there, including talking about productivity and Draghi report, but let's stay focused for the moment. And I appreciate the fulsomeness of your answers, but let's stay focused for a moment on ECB monetary policy. What is, in a sense, holding the ECB back from moving more quickly to cut rates, given, as you said, if we assume the neutral real rate is roughly 2 or a little less, and your rate is currently at 3.5, if the numbers on investment and consumption are both quite weak, obviously there are outliers like Spain that are not, but it's a monetary union. You've got a number of big countries, big economies that are slowing down. So just very simply, why is the ECB not accelerating the pace of cuts it's currently on?
Well,
or what would you want, more accurate?
Yes, we continue working in under this principle of data dependency, and meeting by meeting. We then clarified people that it's not data point dependent, it's trend. Mm-hmm. So we need to be more on this convergence side of the statistician than this quite precise mathematician that goes step by step, and each step is smaller than the previous one. So that's an important concept that I would like to all of us to think about. And when we look forward and not overruling this principle, but taking a little bit more of a tendency over decisions, we do see, and the market has that incorporated, that in the coming quarters, interest rate will go down and will converge, I will say rather quickly, to levels very close to 2%. Will that speed be enough? Data will tell, and I'm sure, and I can assure you that we will react as we proved in October.
Right.
There was this idea out there that the ECB will only move in meetings with projections. It was not a very clever idea anyway, and it was a contradiction with the data dependency anyway. So data accumulates very quickly. Look at the US, when these couple of figures on the labor market early August changed everything. I would like, and I'd rather prefer not to have that in Europe. So we really need to move steady, predictably. And if this tension that I tried to identify this morning with you between the labor market and the economy can be managed, if we don't see things deteriorating significantly in the labor market, as it happened in the US with those numbers that called the attention to what was going on in the labor market in the US, we will be able to follow this trajectory. If it's going to be 25 or at some point we have to do 50, that's something that data will tell us. I don't think the governing council will be not considering a faster trajectory if data tells us to do that. So it's possible.
Thank you for clarifying. I'll be coming to our in-person audience for questions in a little bit. And again, thanks to the governor for doing this all on the record globally. And the video and transcript, as well as his slides and speech, will be available on PIIE.com. Ignore the black helicopters swooping over our building. Let me turn back. You implied a lot in your slides, and you mentioned in your earlier remarks a bit about productivity growth. So let's frame this from sort of the central banker's point of view. As we were discussing prior to your speech, there's clearly a tendency in the U.S. for both members of the FOMC and some market observers to raise the estimate for R-star over time. You've mentioned that you expect R-star to be roughly the same in Europe for the next few years. How much do you see this as a constraint on policy, that if there is a sustained wedge between at least believed R-star in the US and Europe, Euro area, does that affect your policy making? But B, in terms of the Draghi report and other emphasis on productivity growth, what role do you think the Governing Council of the ECB should be playing in any discussions about raising productivity growth trends in Europe?
Well, I'd love actually to be surprised by productivity growth in Europe. We have to go to the fundamentals and be realistic, but there are good signs. And I'm going to start with those, and I mentioned them a little bit in my presentation, and that's the labor market. I'm a labor economist, and I was raised as an economist, considering that productivity developments operate through the labor market, and we need efficient labor markets to have productivity growth, and that's probably the best sign that we have in Europe for the years to come, to be optimistic. If we are able to respect these labor market outcomes, these flows, this mobility, the increased quality of the composition of both employment and unemployment, it may be a matter of time, and be patient, because this takes time to have an impact. When you increase employment by 11 million, you can't expect productivity increase immediately. This takes time. So the best thing that we can do to look into the future with some optimism is to do whatever it is possible, and whatever is very important word in Europe, as you know, to continue, to continue this. We are catching up with the US in terms of skills. The fraction of college graduates in Europe is still below the US. We need to continue that, and if we do that collectively, I am optimistic on that sense. And that's a reason for R-star to go up, okay? But we need investment. And to have investment, there's a word that is very difficult to pronounce in European, which is risk, risk-taking. We developed a quite defensive attitude vis-a-vis risk. The difficulties we faced during the financial crisis, the sovereign debt crisis, it was all about risk reduction. And that almost was set in stone in our DNA when we look at an economy, because there's no increase in productivity without new capital, without new investment, and for that we need risk to be taken. And we need a structure of financing in the economy that is compatible with that risk-taking, and that doesn't exist. It is probably the biggest handicap right now in Europe, is the low level of risk that all institutions in Europe, from politicians to the financial sector, to the European Commission, to national governments, that we see. We don't know how to deal with risk. And without risk, without investment, without betting in new projects that can advance, and I'm not being too much Schumpeterian on this, but a little bit. The enough measure of Schumpeterianism in this, and if that doesn't happen, we will not change the state of play. And I'm going to give you an example. The Mario Draghi report most of the discussion in Europe were focused on the 800 billion euros per year that they present. It's actually a number that comes from the ECB computations a few years ago, which is a quality mark on the number itself, but it is not a big number. Because if you compare the public, and of course when you talk about money in Europe, the public domain pops up immediately. Mario says that 20% of these 800 billion per year should be public money. But this 20% is less of an amount than Next Generation EU.
Right.
So it's not something that we didn't experience already in Europe. It is true that the Next Generation EU was the response to COVID. Well, and Mario Draghi and COVID are not the same thing. but we are blocked immediately when we see figures popping up in terms of investment. And Adam, you know, if you don't invest, if you don't have new capital, that things will not work out. We also need structural reforms. We need to continue the banking union, the capital markets union. We need this to flow through our nations in Europe. But this risk appetite and this risk management that we lack in Europe is not allowing us to move forward.
Thank you very much. A very interesting answer. One last question from me before we open it up to the audience. The last several years seem to have been, even before COVID, a time of relative currency peace. There's been not, a colleague of mine, Joseph Gagnon, might view it as guerrilla warfare, but the fact is there's been very little strife between ECB and Fed, or British pound or Japanese yen over currency issues. And there seems to have been less discussion of the currency in the public statements of the ECB. Is this something you think will hold? Is this something you think is good? Or do you have concerns about the exchange rate system, how it's functioning right now?
Well, we take the exchange rate as a market given in our monetary policy decision and the way we analyze it. But that's for the ECB and for monetary policy terms. Another dimension of this is if you take a more European view on the subject. And for that, right before COVID, also because of the stimulus for that coming from the previous Trump administration, from the Trump administration, we were discussing the role of the euro internationally, openly, which was the first time that we did that at a high level in terms of the political discussion. And so increasing the international role of the euro is important for us to take. But you are absolutely right that in the last few years after that impulse, and especially probably because of COVID as well, that discussion is not on the top of anyone's priorities right now. And I still believe, because I was part of that discussion back in 2019, that is something for us to do. And that's also what can make us more resilient to whatever decision comes up from the US elections. We need to take the emphasis away from complaining or trying to be extremely worried about the elections in the US to do something else.
That's very helpful. And you did mention in your speech briefly this window for the euro.
Yes, yes.
Let me now open up to the floor. Please state your name and affiliation when asking a question. There's a microphone in back, and then there's a moving microphone with Jessica. Please.
FLICKR, here from the Peterson Institute. Well, thank you very much for your forthright remarks, Mr. Governor. I want to come back because of your unique position of both having been a fiscal and a monetary policymaker, obviously. You talked about in your remarks that at some point it is true that monetary and fiscal policy in Europe were pushing in the right direction during during the pandemic. But I think it seems to me, at least, that given what we have now heard from Germany, from France, from Italy, to some extent even for Spain, we're looking at, once again, a situation where fiscal and monetary policy are working against each other in the coming years in the euro area. And at the same time, I think we have a global outlook which suggests that exports isn't going to save the euro area or the EU this time either. And if you're looking at consumer confidence, savings rates, doesn't strike me as coming down anytime soon. So if that's the outlook, and you at the ECB are once again the, if you like, the people looking out for growth only, what makes you think you can get away with, quote unquote, only cutting rates to the neutral rate that you gave me, that you offered, and you don't have to go below?
You are right that and thank you for that perspective, for pointing out to that perspective. If we end up in anytime soon being the only game in town again, that will bring us to the same old statements about the insufficiency of policies in Europe. I'm going to be very clear with you, and I think that risk exists. We are not out of that possibility. That's why we continuously claim and embraced as much as possible the Mario Draghi's report, so that we can move in different directions and with different stimulus. That doesn't say that we should not do our part of the job, but I agree with you that it will not be enough, and it can be exhausted very quickly, very, very quickly, because consumers in Europe they are not of the American type consumers, and that part they dominate very quickly, and it is already doing so. Regardless of that, or not regardless, but I want to underline that it is important to note that the recovery that we have in the forecast of the euro system right now, the mechanism is consumption, which questions even more if that happens to be as we will observe. So yes, I am as worried as we.
Thank you. John, then here, and then Joe. So please.
I'd like to...
Could you identify yourself, please?
Yeah. Jean Pisani, I'm a fellow here at the Peterson Institute. I'd like to push you a bit on what you said in your very interesting remarks on the international role of the euro. Because you said there was a window, we spoke about it, and we stopped, and it's still an issue. And the question is, what does it take for the euro to become a true international currency? Not to become a rival of the dollar. It's not going to be, but to fulfill the functions of an international. And it seems to me the unspoken of issue is a possibility of entering swap agreements with partner central banks. And that's a fiscal issue at core. And that at core something on which the euro area doesn't have, at least didn't take the corresponding decisions. So I'd like to hear you more on this issue.
Thank you for can I answer?
Yeah, of course.
Yeah, thank you for asking that. It's more of a question probably to the president of the Eurogroup than to a governor of a central bank, but I do have an opinion on that. I'm going to give it to you. We need, and I mentioned that in the last part of my statements, we need to continue the process of changing and improving the landscape of institutions in Europe. We need a proper capital markets union. We need to complete the banking union. We need to develop the central fiscal capacity of Europe. It was approved in the last European Council in 2019, right before COVID. It helped a lot, that approval, in the design of Next Generation EU, but we need to face two difficult questions on that, turning that central fiscal capacity and financing it. So, because the financing needs to repay Next Generation EU will start very soon, and we don't have that discussion in Europe. In political terms, because I need to be short, in Europe we still struggle putting two words together, European and sovereignty. Whenever you start a discussion mentioning European sovereignty, the table turns against you, because we don't believe yet enough that we have to face that. And that's true for financial, for economics, for defense, for international positions, for our diplomacy. We do struggle with that. We don't take that very seriously still in Europe. And while that persists, any discussion takes much longer than it should on a more rational basis. To alleviate the pressure on us, I used to comment on an historical statistics, which is before creating the FDIC in the US, the history goes that for 70 years, more than 150 proposals were made to Congress. They were all defeated, except when the Depression came in the 20s last century, and finally it got approved. In Europe, we are dealing with this already for 10 years, maybe more or less. So we still have 60 years to go. I hope it can be faster, and if we can take this European sovereignty issue to the table, it will help us a lot.
I'm very grateful to you for raising these broader historical issues. I need to put in a plug. A few years ago, Jacob Kierkegaard and I edited a project for the European Commission on historical examples of economic integration from the US. And in particular, there was a chapter, I think it was Nicola Veron and Anna Gelpern, on the history of these failed attempts. So we were very strong on this. And of course, Jean Pisani-Ferry and I had a couple conferences here on the global role of the euro. So it's beyond the personal aspect, it's very gratifying to hear a major policymaker like you continuing to think in these broad terms. This gentleman, please.
Hi, Dan Volberg at Balyasny Asset Management. I have two questions, if I might. The first question is, you've outlined sort of this gradual but steady policy easing. And I guess I'm wondering, when you look at the labor market data, it's pretty lagged, but we have a bunch of news pieces about sort of German plant closures, et cetera. And so it's starting to look like there's some follow through into the labor market from kind of the growth weakness that we've seen in Germany specifically. At the same time, it looks like, if you look at some of the forward-looking wage trackers, that wage pressure is still somewhat elevated. So how do you balance those two, and how do you think about the downside versus upside risks here? And then I guess the second question, if you do get a Trump administration in the U.S., and we do get sort of a major escalation on trade tensions specifically with the proposals on 10% tariffs on the world. How do you factor that shock into your reaction function? You know, I guess the last time we had, you know, a big trade war with China, it was certainly more muted, but there was a big move on the currency side. Do you expect that to be the main sort of shock absorber again? And if so, like, does that necessitate some sort of reaction? In the U.S., we saw the Fed tightening in response as well. Oh, sorry, we saw the Fed easing after and tightening into it, right? So I guess you can have sort of a meandering policy response as well.
Thank you, Dan.
Thank you. To complex questions, let's take the first one. In Europe, we do see, as I mentioned, some weakening of the labor market, and point out to some of the issues that are behind this weakening, this easing of the labor market situation. You have layoffs increasing in Finland across the board. You have the issues on the German labor market. You see that in a number of countries. Other countries like Portugal are doing better as of today, but we do see some difficulties popping up already. And that's absolutely natural, and that's where my concern is. Let me be clear, I adhere to the baseline of our projections, okay? We do see a soft landing and some recovery down the road, but then we also have to focus, if not for any other reason, but to communicate the issues that we see around this baseline. And these issues that we see around the baseline are mainly tilted to the downside, as you mentioned. And the severity of these, the materialization of these risks, the answer to that, and honestly, I don't have a precise answer, sorry for that, but I think I can lay down the reasons why we should be concerned, is precisely on, after 8 quarters of virtually zero growth, with employment going up, with some real wage recovery that is badly needed. Otherwise, the economy and the labor market functioning will not be effective. Something has to give. If growth doesn't come, either wages or employment, they must give, and an adjustment, a downward adjustment is expected. And if that happens, of course, this will bring further inflation down. And we spent 10 years before this inflationary process with average inflation in the euro area at 0.9, 10 years, average 0.9. This is rather low to our target. And we need to take that into account. As of the result of the US election, I as an economist, and now I'll try to speak only as an economist, forget that I hold the position I have right now. It's difficult, but I'm going to say it anyway. I don't see any coherence whatsoever in terms of the policies, the set of policies that are pre-announced after the election. So I think we need to look through a little bit that because this will not be permanent in some sense, because they will hurt the economy, they will hurt the US economy. It's a highly indebted economy. You cannot close the borders via tariffs and stop immigration at the same time. I don't know what's going to be of your economy anyway. I am, of course, concerned, but as of the monetary policy dimension, I think if that happens, we need, of course, to precisely evaluate what is the final implementation of those policies and somehow consider them as temporary, because I don't believe that they will be here for a long period of time. Otherwise, we better copy them. If we think they are effective and they are good, which I don't. So I think they will go.
That's a heartening in some ways view, so thank you for that. The final question, please.
Thank you. Joe Gagnon, Peterson Institute. Thanks for coming here, Governor Centeno. Actually, the last question was my question, so, and you basically...
If I didn't answer, please do it again.
Well, let me just put a slight finer point on it. If, as you know, if the election leads to a candidate winning who said he would impose 10 or even 20% across-the-board tariffs on all countries, not targeted at Europe, but would include Europe, my understanding is that Europe would probably immediately retaliate with equal tariffs on the U.S. Maybe that's wrong and you could comment, but if it does, how do you see that in terms of inflation, employment growth in Europe, and the net implications for monetary policy?
Well, it surely will have an impact on the price level, okay? If it has an impact on inflation or not, it will be a function of innovation, technical progress, how good we are at adapting to that and finding alternatives. At home, sometimes we do have, and we just don't look at those alternatives because we think others are better. But again, I don't think that we will destroy centuries of globalization. And I'm underlying this because Portugal had a huge contribution to this globalization with the discoveries of the 16th century. So we were not wrong doing that for centuries and centuries, and now figuring out that we need to go back on some of these issues. I don't believe that. Honestly, I don't. I mean, I need someone to show me the case and prove me the case that we were wrong for centuries and centuries. We need to come up to people and tell them, and it's very important in Europe because of these populist movements that we also see in Europe. Migration is actually saving the welfare state in Europe. It is not a challenge for it. It is saving because we cannot afford working. One of my teachers here in the US was Richard Freeman.
Yes.
And he was always listing this number of hours of work. And it was Mexico, the US, and Portugal. And then in Norway, for example, last 500 hours of work. We will not be able to save this amazingly low number of hours of work. And having women in many of our countries working part-time, 75% of them, if we don't count on this movement and if we don't use them. So I don't think this is good policy. I don't think it will prevail. We need to fight these wrongly designed policies with the contribution that we can.
Wonderful. It's a special bonus for us here at the Peterson Institute who are trying to fight that fight, to have a central banker of your stature come in and not only talk the economics, but forthrightly talk the historic and future implications of this kind of populism against globalization. So with that, please join me in thanking Governor Mario Centeno of the Bank of Portugal.
Thank you, Adam.
We hope you will join us later today at 11 a.m. Eastern Time. The Minister of Finance of Paraguay, Carlos Fernandez, will be with us, and at 2 p.m., Governor Centeno's colleague, Olli Rehn, Governor of the Bank of Finland, will be here. But we're very grateful to have had the Bank of Portugal and Governor Centeno. Thank you.
Thank you.